Okay, so today we're talking about gaps and how gaps can make you money in futures trading, day trading, swing trading, you name it. And so basically, what is a gap? Well, basically, a gap is created when the opening price is either higher or lower than the prior day's price. So on these ETFs, we're going to get gaps pretty much every single day, but we're not going to see it on futures. So we're not going to see it on ES because they trade around the clock. But I'm going to be giving a few examples on SPY and how you can trade some of these gaps. And again, there's a million ways to trade these gaps. This is just from my personal experience from the CMT curriculum, studying a bunch of different textbooks, and personal experience as well. Okay, so basically, the market has been gapping up frequently this past few weeks, and I just want to analyze some of the price action. So look, right here on Tuesday, this is where price closed, right about here. So I'm going to mark that on the chart right here. And look at that. The next day we gap up. Whenever you gap up, you tend to kind of gravitate in that direction. The next day on Wednesday, the market kind of just did a little consolidation, went higher, and then came down to what? Test the gap. And what was support? In and around the gap. So the first touch of a gap tends to have the most amount of buy orders for a move higher. On a gap down, generally, we can mark this from Friday into Tuesday. This is going to be an area of resistance. So look, this is the gap from Friday, big push down, gap down. You kind of have a bit of a sell-off, gets oversold, rebounds. Okay, so we've marked Tuesday's gap. We've marked Friday's gap. Look at this. Friday's gap turned into resistance on the first go around here on Thursday. Okay, and price rejected. So if you need a trading setup or are just looking for an area where there's a good chance there's going to be some sort of support or resistance, check out the gap. And price moved lower, but remember, it gapped up, so trends tend to persist in that direction. So that's one way to trade gaps. Another way to look at gaps is price above or below the gap? That's telling us whether price is bullish or bearish. So Thursday had a big squeeze day, and we want to mark that gap. That's where we closed price. Price gapped up. Okay, we could trend higher, but the market was pretty extended up there. It had a nice opening range breakdown. Basically, you can mark your highs, mark your lows. Price broke the lows and started to sell off. Now, normally, price would have had some sort of support. Guess what? This time around, price did not have support. And so when you turn the gap into resistance, that's where you can see a reversal in the price trend. Okay. So hourly closes, 4-hour closes beneath the gap tells us, hey, price is a little bit more bearish. And we're going to see this next week, how SPY 649 acts. Usually on the first go around, it should be some sort of resistance. If price rejects harshly from a gap, that tells us that that is indeed resistance. Gap has been filled. Price can reverse. If price gets above and holds above the gap, that would be more bullish for the market in the short term next week. Okay. So remember, hourly and daily closes above a gap is generally bullish continuation. Hourly and daily closes beneath a gap is generally bearish continuation. So a simple trading strategy, always mark your gap levels at the open. Watch for the first clean test. Is it rejecting? Is it supporting it? Is it turning it into support or resistance? How is it holding around the gap? Okay. And if you're placing stops, you can place your stops just beyond the gap zone. So let's say I took this long trade on Friday. I would have just stopped out because it started to turn the gap into resistance. It was no support. It was just a waterfall sell-off. Conversely, on the other days, okay, I can buy near the gap. Technically, the gap was pretty much there. One other tip, you guys, is mark your gaps. And if price comes short of a gap and then bounces, that's really bullish. That basically is saying price wasn't weak enough to even test the gap. And you can see a trend reversal in the other direction. Most of the time, gaps do fill, but they don't always have to fill. Okay, there's a ton of unfilled gaps on the S&P 500. So just note that. Gaps also tend to be magnets. So that's why they're really, really key levels. They tend to be magnets for order flow. Okay. Bigger news, bigger gaps tend to be a little bit more reliable. Okay. If it's just a small gap, it may not be as reliable. If there's higher volume on the test of the gap, that can be more reliable to take that bounce trade. If there's low volume when it's testing the gap, it might just chop or just break through it. There's a decent amount of bear volume on Friday, and that maybe it gave it the energy to actually crack that lower. Okay. So just in summary, gaps, they're kind of like in balance zones. The first test is the best test. We have a saying in victory trades, in futures trading, don't molest the move, because the most amount of orders are going to be there the first time. Think of like a hammer on glass. If you keep it, the first time you take a hammer to glass, it may not break, but the glass probably weakens a little bit. You take another hammer to that glass, it weakens a bit. Third time, fourth time, fifth time, glass breaks and it shatters. That's how you want to think of support and resistance levels. It's eating up the orders the more times that it tests that level. Okay? And remember, a gap up generally have a slight bullish bias. Gap down have a slight bearish bias. But be open-minded. Don't overtrade. Always manage risk. Hopefully you guys learned something new about gaps, how to trade them. That's just a quick summary on them. Let me know if you guys have any questions. Peace.